one of the situations in trading that I firmly believe in, and is very, very close to my heart indeed, is the idea that every trader should have some sort of trading plan, a set of guidelines or principles and certainly objectives by which they're trying to achieve that invoke some sort of discipline within their trading. It gives them a positive expectancy and ultimately gives them their confidence that they need to go forward and try and profit in financial markets. So for me, I advise everyone to get a trading plan together. And, obviously that's going to be very personal to the individual, and trading by its very nature is very personal, and that's something I'm going to touch on in this video. And it's something I touch on in different areas within the Trading of Confidence series that I've put together. But certainly I think having a trading plan, whether you're a new trader or whether you're an experienced trader, I think really will set you apart from being successful over the longer term and being less so successful in markets going forward. So really want to focus on a trading plan for every individual out there. The first question, of course, is what are you trying to achieve from the trading account? Everyone has their own objectives. That's very personal to the individual. My own set of objectives is that I want to try and grow the capital within my trading accounts. I want to do it in a measured and balanced way, and specifically I want to protect the capital and look at the risks and manage the risks around that capital going forward. So that's really what I want to achieve from my trading account. And everyone obviously wants to grow the capital in their account. It's a question of how that capital is grown, whether you're going to do it in a reckless manner and try and grow for significant profits very, very quickly, or you do it something in a more measured, balanced approach, which of course is what I'm trying to achieve here as well. So again, that's down to the individual and what they're trying to achieve. But I think everyone should ask themselves, as the front run of a trading plan, is what exactly are you trying to achieve? And I think from that perspective, when you realise what you're trying to achieve, you can set the parameters of that trading plan quite significantly as well. Adjusting for volatility, I think, is something that everyone needs to understand. So what is the leverage of the product? Every product that you're trading on a contract for difference or in the market has a different leverage perspective coming through. And of course, when the market itself has different different levels of volatility. And for me, the two things I look at very, very closely with volatility is, one, how do I change my risk management strategy for the increases or decreases in volatility? Generally, when you see higher volatile moves, bigger range intraday expansion, I'll tend to move my stop loss further away from the market. That gives me a better chance of not getting stopped out, but also reduce my position size accordingly. From a strategy perspective, if you see high volatility in markets, that means you see risk really coming under a bit of pressure. You'll probably see the unwind of yield or carry trades in the FX market. And when you see low volatility markets, you'll see a situation where people look at income structures much more closely, and they'll look at very high yielding assets, whether that's in the bond market, in the equity market, or in the currency market as well. So I think one of the situations is how your portfolio adjusts for volatility in the market. That's a really key input for me. But specifically, and what a central part of my trading plan is how I adjust higher volatility, higher risks in the market for my risk management. Do I top my stop loss further away? Do I reduce my position there as well? So volatility and how you cope with that, I think, is absolutely key. Consider lifestyle, personality and circumstances. Again, trading is very personal to the individual. No one trader is the same as another trader. So someone who might be very much a mechanical mindset, someone who might be very much into probability and statistics, may look very much at mechanical or systematic trading. Some people may be less patient. Some people may be more patient with markets. Some people might like to trade off their own views and discretion, and that's where you can come and look at discretionary trading, which of course most of our clients do. But significantly, how you believe in markets, what's your own mindset, and also your own circumstance. You may be in a job where you can't look at markets very actively, and in that situation that will determine how active you can be in markets, whether you're trading on 1 minute charts or daily charts or weekly charts as well. So you've got to look at your own circumstance, your own personality, and those situations will feed very much into how you trade, the strategies you trade, and the execution of those trades as well. So what type of trader am I, which is a byproduct of question 3 there. I personally trade on a mixture of fundamentals and technicals. Everything I do, I'm trying to extract the highest probability setup, so I like to trade with the trend. I believe if I'm trading short-term financial products, I want to trade with line with the money flow and try and catch the body of the move. Sometimes I'll look at mean reversion strategies and therefore looking at trying to pick tops and pick bottoms, but generally I'll look at trend following as well, and I'll apply a technical analysis focus with a fundamental focus too. And if I can combine the two, again, that's really where I'm looking for that high probability setup. So what do you really want to achieve? Do you want to become a technical trader or a fundamental trader, or do you want to do both? It's all about probability in my mind, and it's really about how you feel comfortable as a trader. And again, that goes into the idea of personality. It will feed into how good you feel and how specific and comfortable you are with the way of trading. Understand price action. Before you look at RSIs and MACD crossovers and stochastics and you draw a million different moving averages on your charts, my one bit of advice to every trader is understand price action. Price action is just a roadmap of supply and demand. I like to look at candlestick charting, and that really gives me an idea of who's in control of the market. But when you're seeing so many different players in the market, whether you're a speculator, hedge funds, exporters, real money accounts, life insurance accounts, whether you're a reserve manager who is acting on behalf of central banks, all the key players within the market, effectively price action, or what we see from candlesticks, effectively blends that all together. It rationalizes human behavior. And for me, getting an understanding of price action before you even look at technical analysis is absolutely key. So that's the first thing I would advise people to do, is have a look at price action and get a clear understanding of that. It really helps positivity within short-term trading models. So that's really, really key for me. And risk management. If I'm looking at that positive expectancy, I need to be a manager of risk. Everything I do is a manager of risk. I am going to effectively cut back on losing trades as quickly as I can. I'm going to allow my profitable trades to run. Regardless of what happens with my win-loss ratio, I know that if I run my profits, effectively I can allow myself to make losses. Society tells us that we have to be right on every single trade, but then trading, that's not actually true. All you need to do, and it sounds simple, but it's not at all, is allow your profits to run. How you go about doing that is up to you. But effectively, if I can cut back on those losing trades, if I can say to myself, you know what, Chris, my analysis is wrong, cut back on those positions that are losing very, very effectively, then I'm a manager of risk. So everything in your portfolio when you go into the trade is about how you manage that risk around the trade, how you manage that portfolio protection. And I think that's really key. That's what separates good traders from bad traders. And a stop loss for me is, of course, very, very essential for that. A stop loss suggests to me, this is a point on the chart where it says to me that your analysis is wrong, Chris, you're wrong, get out of the trade. And if you could admit you're wrong, you're going to give yourself a positive expectancy in market. It's what defines my risk there. So a trader is a manager of risk, and that's very important. Managing positions around key event risks. For me, I look at what's going on when I'm combining fundamentals and technicals. I like to look at what's happening with event risk, what's happening at the ECB meeting or an RBA meeting or an employment report. Just see how the market's positioned, get a gauge of sentiment to really get a see of whether there's going to be some high volatility. A lot of people do like to trade around these events, but personally, I think it's good to cut back on that exposure when you think there's going to be a really volatile move, and it could go either way, you just don't know. Sometimes in that situation, I'll actually trim back on my exposure just to manage that risk. So again, I might look at markets on a technical basis, but I'll use a fundamental and discretionary view to assess different event risks that are coming through. And if I just don't know how to play that, it could go either way, then I think sometimes it can be prudent to cut back on that risk and manage that exposure there as well. And that's a really good example of managing fundamentals and technicals there as well. Continuous improvement. I like to see, as in life, that if something's working, you tend to do more of it. And if something's not working, you tend to do less of it. But trading's one of those few games where you see a situation where something's not working and people continue to hold that uncomfortable position. It's one of the few things in life where you just question what it all means. But for me, if I'm doing something well in trading, I want to do more of it. And that means potentially adding to positions. If something's working for me and I've gone long a stock and it's going up, why not buy more of that situation, but cut back if it doesn't work against me? So in life, do more of what works. In trading, do more of what works and do less of what doesn't work. And I think continuous improvement is very, very key there. Write down what you're doing, and you can find that out very well. So a trading journal is really, really key. So continuous improvement, always try and be a better trader where you can. And a trading journal is really key in that scenario there. And then lastly, I think if you bring this all together, ask yourself, do I have an edge? A casino has an edge because it has a higher probability, whether that's 51 or 52%, depending on the game that's involved, they have an edge, and that is probability. Ask yourself, what is your probability? What is your positive expectancy? What is your edge over everyone in the market, and also, all your competitors there as well? So bring this all together, and of course a trading plan really helps you to do that. So everything you're doing in the trading plan is about how you run it as a business, in my mind. What's your competition? How do you beat your competition? What's your edge? How do you manage your risks? And I think if you can bring it all together and create your own individual trading plan, that's really where you get that positivity expectancy.